The 4% paradox. Why America's oil share is shrinking while demand explodes. The United States holds 4% of the world's people, but burns 20% of the world's oil. And that ratio is tightening not because we're using less, but because 2 billion new people in India and Africa are claiming their share. In 3 minutes, you'll see why the U.S. oil demand flatlined even as 60 million Americans were added to the population, why global consumption climbed 36% while the planet added 2 billion people, and where the next 30 million barrels per day of demand will actually come from. I'm Mark Roach, petroleum engineer and deal maker. Some people call me an oil man. With 30 years in the industry, this is FutureWise Energy. This is an independent analysis. The data, 282 million Americans in 2000 using 19.7 million barrels of oil a day. Today, 343 million Americans using 20.6 million barrels per day. I'm Mark Roach, petroleum engineer and deal maker. Some people call me an oil man. With 30 years in the industry, this is FutureWise Energy. This is an independent analysis. The data, 282 million Americans in 2000 using 19.7 million barrels of oil a day. Today, 343 million Americans are using 20.6 million barrels per day. That's 22% more people and only 5% more oil. In 2000, the U.S. held 4.6% of the world's population and consumed 25.7% of the world's oil. A 5.6 times multiplier that made American per capita consumption the highest on the planet at roughly 24 barrels per person per year. By 2025, the U.S. share of world population slipped to 4.2%, and the oil consumption share dropped to about 19.8%, cutting that multiplier to about 4.7 times. Well, that sounds like progress until you realize the denominator exploded. World population jumped from 6.1 billion to 8.2 billion, adding 2.1 billion people, while world oil demand climbed from 77 million barrels per day to 105 million barrels per day. A 36% surge. So the U.S. didn't shrink its appetite. The rest of the world finally showed up at the table. American oil consumption per capita has hovered near 20 to 23 barrels per year for a quarter century, a flat line that reflects vehicle fleet turnover, building efficiency codes, and a structural shift from manufacturing to services. And that plateau isn't virtue. It's market saturation in a rich economy where nearly everyone who wants a car already has one, where suburban sprawl hit its geographic limits a decade ago, and where incremental demand growth comes from population gains, not lifestyle intensification. Meanwhile, China consumes 3 barrels per capita, India 1 barrel, Indonesia 2 barrels, and Africa as a continent averages less than a barrel per person. Now, those aren't rounding errors. There are 2.8 billion people with consumption footprints 1/10 to 1/20th of the U.S. level. And every small step up that ladder translates into millions of barrels of new global demand. Between 2000 and 2025, the world added roughly 2.1 billion people, with India contributing about 410 million, Africa approximately 720 million, together accounting for more than half of global population growth. U.S., despite an aging population and falling birth rates, still grew by 61 million people, a 22% increase driven by longer lifespans, immigration, and natural increase. The U.S. oil consumption rose by less than 1 million barrels per day over that same period, translating to a decline per capita consumption rate as efficiency gains and fuel economy standards offset population growth. The global picture tells a radically different story. World oil demand climbed 28 million barrels per day, with non-OECD countries driving essentially all of that growth. India's oil demand is projected to grow from roughly 5 million barrels per day to 8 million barrels per day by 2030, and potentially 12 million barrels per day by 2050 as the country adds another 170 million people and continues urbanizing at breakneck speed. Africa, with a population now at 1.55 billion and still growing at over 2.3% annually, remains the world's fastest expanding demographic. Yet currently it consumes less than 5 million barrels per day across the entire continent, a per capita rate so low that even modest development gains will trigger massive demand increases. China, already the world's largest or second largest consumer at roughly 16 million barrels per day. Well, they're projected to add another 2 million barrels per day by 2030, despite aggressive EV, electronic vehicle adoption, because the sheer scale of its industrial base and expanding middle class overwhelms substitution effects. The other Asia category, well, Southeast Asia, Pakistan, Bangladesh, and smaller markets, well, they're expected to see oil demand rise from 7 million barrels per day in 2020 to over 13 million barrels per day by 2050. That's driven by population growth, infrastructure build-out, and rising incomes. The Middle East, already a significant consumer, will add another 3 to 4 million barrels per day as petrochemical complexes expand and domestic energy subsidies, well, they keep consumption artificially high. Go figure. Even Latin America and sub-Saharan Africa, often overlooked in demand forecasts, are projected to add 1 to 2 million barrels per day each by 2030 as vehicle ownership rates climb and diesel-powered logistics networks expand. The U.S. oil demand plateau, well, it isn't policy triumph. It's a natural endpoint of a development curve that began a century ago. American vehicle miles traveled peaked around 2005. They dipped sharply during the 2008 financial crisis and recovered modestly, and then cratered back again in 2020 before bouncing back to near 2019 levels. But the composition of that demand shifted gasoline consumption, which represents about 45% of U.S. petroleum use. And that's been essentially flat since 2005 as fleet fuel economy improved from an average of 20 miles per gallon to nearly 25 miles per gallon. Diesel demand driven by freight logistics and industrial activity has shown slightly more growth, but even that has been capped by efficiency gains in trucking and rail. The broader U.S. economy underwent a structural transformation over the past 25 years. Manufacturing as a share of GDP fell from 16% in 2000 to under 11% today. That's 5%, replaced by services, technology, and finance, sectors with far lower energy intensity per dollar of output. Residential and commercial energy use shifted toward electricity and natural gas, reducing direct oil consumption for heating. Building codes tightened. Appliance efficiency, well, the standards have raised the bar. And there are behavioral changes. Remote work, online shopping, reduced transportation energy even before COVID accelerated those trends. Population growth in the U.S. added 61 million people, but those people were absorbed into an economy that had already built out its oil-intensive infrastructure. New suburbs look remarkably like old suburbs. Vehicle ownership rates stopped climbing decades ago. The incremental demand came from population increases, not from individual consuming more oil per capita. The result? A per capita consumption declined from roughly 24 barrels a person in 2000 to about 21 barrels per person in 2025. even as total population rose 22%. Well, that's efficiency that's been imposed by market saturation. And it's not a deliberate conservation policy. So don't pat yourself on the back. Global oil demand growth is now entirely concentrated in non-OECD countries, with India, China, other Asia, the Middle East, and Africa collectively adding 20 to 30 million barrels per day between 2000 and 2025. This isn't speculation, it's the arithmetic of development. India's vehicle fleet is projected to grow from roughly 300 million vehicles today to over 600 million in 2040. That's driven by a middle class expanding at 15 to 20 million people per year. Africa's vehicle ownership rate currently sits at 45 vehicles per 1,000 people compared to 850 per 1,000 in the US, meaning that even modest convergence toward global averages implies tens of millions of new cars, trucks, and motorcycles over the next 2 decades. Petrochemical demand, often overlooked in simplistic transportation or transport electrification narratives, is surging in emerging markets as plastic consumption, fertilizer use, and synthetic material production are scaling with GDP growth. India and China are building petrochemical complexes at a pace that will double their combined capacity by 2035, locking in feedstock demand for decades. Aviation fuel demand, recovering from pandemic lows, is expected to exceed 2019 levels by 2026 and grow an additional 40% by 2040, driven almost entirely by Asia-Pacific traffic growth as new middle-class consumers take their first international flights. The equity dimension is impossible to ignore. Americans consume 21 barrels per capita, while Indians consume one barrel. Yet both populations grew over the past 25 years. The US added 61 million people and increased oil consumption by 5%. India added 410 million people, nearly 7 times more, and increased consumption by roughly 150%. Africa added 720 million people, more than twice the entire US population, yet total African oil demand remains below 5 million barrels per day, less than a quarter of US consumption. The implication: if emerging markets converge even halfway toward OECD per capita consumption levels, global oil demand will exceed 130 million barrels per day by 2040, rendering current peak demand forecast absurdly premature. For US producers, the message is blunt. Your home market is tapped out, but the export market is structural and growing. Gulf Coast refineries optimized for heavy crude, midstream infrastructure built to move product to export terminals, and LNG facilities coming online through 2027 all reflect the recognition that marginal demand growth lives overseas. The companies that will win in the next decade aren't those drilling the most wells in the Permian. They're the ones with integrated export platforms, joint ventures in Asia, and logistic networks that turn flat US demand into a throughput advantage for global markets. For policymakers, the equity challenge is unavoidable. Telling 2 billion people in India and Africa that they can't have energy-intensive lifestyles that we Americans have enjoyed for a century is not credible, nor it may not even be just. The energy transition, well, it's happening, and it's going to happen on top of all these baseline oil demand projections and in these emerging markets, not instead of it. Electrification of transport in China, India, and Southeast Asia is proceeding faster than in the US. Yet total oil demand in those regions continues climbing because vehicle fleet growth, industrial expansion, and petrochemical buildout dwarf the substitution effects of electric vehicles, EVs. The climate math is harsh. If the world is serious about limiting warming to 1.5 degrees Celsius, or even 2 degrees Celsius, the constraint can't fall disproportionately on populations consuming 1 to 3 barrels per capita, while the US, Canada, and Europe cruise along at 15 to 25 barrels per capita. Either rich countries accelerate their own demand reductions through aggressive policy, carbon taxes, fuel standards, infrastructure redesign, or the atmospheric budget gets burned through by entirely predictable and morally defensible development in the global south. There's no third option that avoids that arithmetic. 4% of the world's people use 20% of the world's oil was always in an unstable equilibrium, sustainable only as long as the other 96% stayed poor. They're not staying poor. India, Africa, and emerging Asia are climbing the development ladder, and every rung that they ascend translates into millions of barrels of new demand that U.S. efficiency gains can't offset. The U.S. added 61 million people and barely moved oil consumption needle because we hit the market saturation 2 decades ago. The world added 2 billion people, most of them in India and Africa, and oil demand surged 36% because they're still in the steep part of the curve. So if you're pricing risk, trading barrels, or allocating capital, the signal is clear. Marginal demand lives where population is young. Incomes are rising and per capita consumption is nowhere to go but up. That's not the US. That's not Europe. That's Mumbai, Lagos, Jakarta, and 50 other cities you can't find on a map, but that will shape the next 30 years of energy markets. Recognize the shift before the market forces you to. I'm Mark Roach. This is FutureWise Energy.